Hey guys, it's Julie here with TipRanks. With US tariffs back in the spotlight, today we're looking at 3 energy stocks that could stand to prosper. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. New U.S. tariffs imposed by President Donald Trump on goods imported from Canada, Mexico, and China went into effect midnight last night, igniting fears of potential trade wars and economic downturn. Now, many companies are going to be affected by these tariffs, but there are some that could potentially be boosted. Some energy companies will benefit from reduced competition due to tariffs on international energy imports and an increase in domestic production demand. So today we're going to take a look at 2 oil and gas companies that could see a boost as tariffs on Canadian oil could make US the crude king again, and also a solar energy company whose US-made panels could shine brighter as Chinese imports also face those tariffs. Just before we get into these stocks, this is a reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. You can check out these stocks over on the TipRanks website or right on your mobile device with the TipRanks mobile app. Links will be in the description down below. Now let's jump right into these energy stocks. Diving right in, we're going to start with Cheniere Energy, who is the leading U.S. exporter of liquefied natural gas, or LNG. They began their operations in 2016 and are already the largest producer of LNG in the United States and the second largest LNG operator in the world. Their LNG has reached dozens of markets on 5 continents, and demand for their fuel is expected to grow as countries around the world seek cleaner ways to power their economies. They're headquartered in Houston, Texas, with LNG facilities in Southwest Louisiana and South Texas. With those terminals in Louisiana and Texas, Cheniere has been shipping LNG to Europe and Asia like never before, and Europe is still hungry for alternatives to Russian-produced oil, with Cheniere locking in several long-term contracts. Tariffs on foreign-produced LNG will make imported LNG less competitive, opening up opportunities for Cheniere. They trade under the ticker LNG, currently priced at $220, having gained 44% in the past year. In the last 3 months, they are down slightly at 2.6%. Looking back just a couple of weeks ago, Cheniere Energy did share their fourth quarter earnings report, coming out with a big earnings beat and revenue that was in line with expectations. During the quarter, they produced a record amount of LNG of approximately 45 million tons, which is over 10% of the global LNG supply. That fourth quarter earnings per share came in at $4.33, well ahead of the $2.70 expected, while revenue of $4.4 million was in line with analyst expectations. The company also introduced full-year 2025 financial guidance. They're targeting $6.5 to $7 billion EBITDA in 2025 with expanded LNG capacity. Management said that they expect 2025 to be another record year for LNG production, and they plan to double their current LNG production by building more export facilities at the Sabine Pass and Corpus Christi facilities. The LNG stock has attracted 15 current analyst ratings and does come in as a unanimous strong buy. With an average price target of $255, the upside potential would be 16% from current prices. Looking at those ratings down below, we have recently seen a couple analysts increase their price targets as well. Our low-end price target is a buy at $220, which would be fairly flat from current prices, while our high-end price target comes in at $303 from a 5-star analyst at Jefferies for an upside of over 37%. Next up, we're taking a look at a household name in oil and gas, Chevron. Chevron is an American energy company that explores, produces, refines, and sells oil and gas, and also generates power and manufactures chemicals. They have major operations in important oil and gas regions around the world, but about half of their workforce is based here in the United States, with 5 refineries in the U.S. through Texas, California, Mississippi, and Utah. They have a notable market share in the United States in oil drilling and gas extraction, petroleum refining, and gasoline and petroleum bulk stations. While they are one of the world's largest integrated oil and gas companies, they do have a very strong domestic focus and presence in the Permian Basin and the Gulf of Mexico or America, whatever we're going with now. And with these new tariffs in place, they stand to benefit from an increased focus on U.S. energy. For example, tariffs on Canadian crude will make Chevron's Permian Basin oil cheaper for U.S. refiners than, say, imports from Alberta. The Chevron stock trades under the ticker CVX, currently priced at $152 per share. Overall, the stock has gained over 6% in the past year. In the last 3 months, it's down about 3%. With Chevron being an international giant, there are going to be some mixed impacts. While they are set to benefit domestically, there have been some things happening internationally as well, as President Trump has been looking at pulling their license to operate in Venezuela. In fact, the Trump administration did just confirm that they were formally rescinding their license to pump oil in Venezuela, giving them 30 days to wind down operations. Right now, Chevron exports more than 25% of the country's entire oil output, and that has provided a steady source of revenue to the Venezuelan government and economy. Chevron's latest earnings report came out back on January 31st. They did have mixed results, with a miss on earnings, a revenue beat, and record production. They grew their Permian Basin production nearly 18% from the previous year, and also returned a record $27 billion in cash to shareholders through dividends and buybacks. The Q4 earnings per share came in at $2.06. That fell 5 cents short of analysts' expectations. Revenue, on the other hand, grew over 10% year over year at $52.23 billion, beating by over $3.8 billion. The stock currently has 15 analyst ratings and does come in as a strong buy with 12 buys and 3 holds. And analysts' average price target comes in at $176, implying an upside potential of over 15%. Looking at those price targets down below, on the low end we do have a couple of hold ratings at $160 for an upside of 4.6%, while our high-end price target comes in at $203 for an upside of over 32%. If you've made it all the way to our third stock today, then this is a reminder to make sure you've hit that thumbs up button. For our third stock, we're moving to a leader in the U.S. solar panel industry with First Solar. They're focused on designing, manufacturing, and selling photovoltaic solar energy solutions. They specialize in producing thin film solar panels using cadmium telluride technology, which is known for its lower cost, higher energy yield in high temperature environments, and reduced environmental impact. They develop, construct, and operate large-scale solar power plants and sell the electricity generated under them in long-term agreements. First Solar is among the world's 10 largest solar manufacturers and is the only one headquartered in the United States and not manufacturing in China. Though they do have some other operations around the world, they are heavily invested in U.S. manufacturing. And this is what's going to give them the edge, as tariffs on Chinese-made solar panels are going to increase the costs. First Solar is going to stand apart. Their stock currently trades under the ticker FSLR, priced at $134 per share, and they are in the red this year, down 15% and down 31% in the last 3 months. Over this past year, the stock has been facing several headwinds, including some competition from Chinese manufacturers, some policy changes with the new administration, but also an earnings miss for their last quarter that came out on February 25th. In that quarterly report, the company did highlight record-breaking module sales and increased manufacturing capacity, driven by new facilities in Alabama and throughput optimization in Ohio. But looking at the earnings per share, it came in at $3.65. That fell $1.05 short of analysts' expectations. Revenue, on the other hand, grew 30% year over year, coming in at $1.51 billion, beating by $30 million. Looking ahead at 2025, the company anticipates net sales of $5.3 to $5.8 billion. With this decline in stock price, several analysts have noted that First Solar is approaching an attractive entry point, and with 25 current analyst ratings, it does come in as a strong buy. That is based on 22 buys and 3 holds. And the average price target comes in at $252, implying an upside potential of 90% from current prices. Looking at those ratings down below, we do have quite a few analysts who did lower their price targets, but still maintaining that buy rating and still with some pretty big upside potentials here. Our low-end price target is a hold at $150 for an upside of 13%, while our high-end price targets, we have a couple here, at $304. That would be an upside of 128%. Of course, the political landscape around these tariffs and different trade agreements will change week after week, so keep an eye on all of that. But that is a quick look at 3 energy stocks that could stand to benefit from these newly imposed tariffs. Let me know your thoughts in the comments down below. I know it's an interesting topic, and I always appreciate hearing from you guys. Please keep in mind that these videos are definitely not a suggestion to buy or sell any specific stock, so make sure you always do your own research and due diligence. Thanks so much for watching. Have a great day. I'll see you back here next time.